value investing, and do you believe in it?
I think a traditional value investing is like, you're buying things on low price earnings ratios with big dividend yields and this kind of thing. Or you could be looking at book value, where you're looking at the company's assets. So this is very much the Ben Graham idea of investing, where you're trying to buy something for, that's market's capitalization is less than the value of its assets. And with Ben Graham, he's very much into margin of error, margin of safety. So you'd be buying at, say, 70% of the company's assets. That's very much value investing. Personally, I don't do that. It's not really my scene. It's something I would consider, and I've actually got a share called Molin's, MLIN, which you could argue is a value investment because it's on quite a good discount to its NAV. But personally, I'm buying it because I think it's a turnaround situation. I can see the company is going to, it looks like it's going to recover and do really well. So I'm buying it for that reason more. In terms of the other way of looking at value, it is growth. It's like people think growth investing is different to value investing. Well, for me, it's all the same. It's like if a company is growing fast and it's growing consistently at 30% a year, then as long as the price earnings ratio is 30 or below, the forward price earnings ratio, and to me that's good value. You're not paying a lot for a massive amount of growth. That's all about the PEG ratio, price earnings to growth ratio, and it's very much the sort of principles that Jim Slater in his book The Zulu Principle talks about. And Mark Slater, his son, is he's one of my favourite, fund manager, investors, whatever. Mark Slater is really into that idea of growth at a reasonable price.
How do you determine whether a company is overvalued or undervalued?
For me, a lot of people don't like PE ratios, but for me, I love the PE ratio. I think it's the first thing I look at. Straight away, I'm like, right, what is its ratio? And it's all about, you need to understand the context. Some companies, like a sort of house building company, they would very, very rarely be on a PE ratio over maybe 14 at the most. If it's on more than that, it's probably getting overvalued. Whereas other companies on a PE of 14 are absolutely steal. It's like if you've got an e-payments company and it's on a PE of 14, that's probably the best bargain you're ever going to see. So it's all about understanding the nuances of PE ratios and stuff, and this price earnings to growth thing, understanding, if you've got a PEG ratio that's less than 1, it's probably a cheap share. If the PEG ratio is up to 3 or 4, that's probably expensive. And so it's those kind of things.
Can you make money trading for dividends?
Yeah, I'm not really sure what that means. I guess, as I say, with my income portfolio, it's very much I am after the dividends. It's a very lazy portfolio where I'm just looking for those sort of 5% dividends every year to just keep going in and steadily rising over time and getting some capital appreciation as well. So I guess from that point of view, you can. From the point of view of, some people think you can sort of like scalp a dividend and all this. I'm not convinced you can. It's a lot of hard work. Because as soon as they go ex-dividend, they drop by the amount of dividend anyway. So what's the point?